delighted to be back here. For those members of ShareSoc who came to the Edison Growth Conference, it was good to see everyone there. You would have seen both me and Lord Ashbourne, Charlie, at the event. Charlie put out a piece, I think, in December, focusing on gold and why gold looked like an interesting asset class. At the time, I think gold was flirting with about 2,200 an ounce. Today, we're closer to 3,200. And really, what we wanted to talk about today was reflect on the performance of gold and where it might go, but then think about how we can extract returns actually looking on the equity side. We are going to talk about some stocks. As Mark said, this is not investment advice. Our job is to provide good quality information and education to everyone. But we're happy to take questions afterwards. I'm going to take Charlie through his last report, which was on gold miners. And Charlie, let me start with the macro side. I mean, you talked about a gold side upside range of $3,300 to $4,500. And you've seen, I mean, well done, you got it right. Has the recent strength of gold changed your outlook on this range at all?
I mean, I don't think it's fundamental. It's quite a wide range there. I don't think it has fundamentally. But look, I've got a few slides here. Would you mind if I just tee them up and then I can sort of run through where I think we are in terms of the cycle at the moment. So just shout when you can see my screen. And hopefully it will come up any minute now.
Yeah, there you go.
Fabulous. All right. So what I'm always trying to do when we sort of run through, where we are with the gold cycle is always compare it to history and where we were. And I think this is the fundamental chart that sort of shows the fundamental similarity between what has happened since 2004 to the present. And what that really means is the global financial crisis depending on where you want to measure it from, 2008, and compare that with the previous cycle where we had this same sort of huge gold run up from 1971 to 1981. And if you're looking on the x-axis there, that is months from the start, not of the crisis, but of the start of the run that synchronizes. And where these two are both synchronized is at month 49, where you can see there's a nadir in real interest rates. So you're comparing the two green lines, which are the modern day cycle, with the two gray lines, which are the cycle in 1971 to 1981. But you can see in both cycles at about month 49, so 4 years into it, from where we start. So you're talking about June 2008 roughly, and you're comparing that to January 1975, and you're saying that's where there was a nadir in real interest rates, and for these purposes I'm defining real interest rates as the Fed funds rate minus the inflation rate. And a couple of things you can see is that, one, the current cycle, and the reason I'll just go back and talk about this for a minute, but the reason I think it is all one crisis, although the period from 2004 until now is much, much longer, is because you didn't really have the end of the effects of quantitative easing until deep into the 2000s and teens, deep into the Obama era. And then we had very little time to sort of come out of that. And then we went straight into COVID. Now, COVID is obviously a different facet of the crisis. We didn't have the equivalent in 1971 to 19, but you can see COVID. I hope you can see my cursor there just moving. Yeah. I've gone one too far there. Anyway, but that's why I think we're in all one crisis here. And what you see is that we have just come out of a period of neutral to real interest rates. So we've gone from neutral to about plus 2% real interest rates. And I'm comparing that in the same sort of situation in the 1971 to 1981 cycle. And that's kind of August 1979 sort of time. Now, if you look at this slide here, this will show you the equivalent. So this is where we've been for 2004 till April 2023. And that looks like quite a decent grouping of points where you're comparing real interest rates and the gold price. There's a decent correlation between the two, and you think, all right, well, we know what real interest rates are, so we can pick the gold price. And if you look at that and you say, actually, that looks a bit miserable for gold, because if real interest rates are going positive, then you'd expect the gold price to fall. And then what I'd do is I would compare that with 1971 to 79 cycle. So in August 1979, that's where we were at that at the point that's marked. Again, there's a decent enough correlation there. If you can predict real interest rates, then you can predict the gold price. Real interest rates in both cases just slightly negative. You would say that the outlook looks a bit poor, but what actually happens in the 1979 case is this. You see where those arrows are starting from, those blue arrows there, that's the same point there. The one that was highlighted before. And what happens is that real interest rates go up, but the gold price goes up, and then real interest rates go down, and the gold price then goes up a lot more, excuse me, and then it fundamentally rebases, and it rebases to this line over here. And there are a number of ways of interpreting that, and then we start a whole new cycle again. But if you think about it, gold really kind of, since real interest rates are always in this range, gold has to rebase sometimes, and I think this is one of those periods of time, and you'll see it on the next slide, I think quite clearly, is again the current cycle, but rather than finishing in April 2023 as we did before, that was that point there, that last point. What's happened? Well, we've gone out here and we've gone up, and we're a long way towards this resetting, if you like, of the base of the gold price. And what I think would, if you look at the sort of where the fundamental line was before and where it went to in the 1971 to 81 cycle, and then you say, well, where is the line now? And that's that lower line there. And then what should it be if it went up by the same amount? Well, you're looking at that line there, which I call the high line. And that's what I think we're heading towards. So we got 2% real interest rates. I think we're heading for, on this basis, north of $4,000 an ounce. Has that changed much since we last spoke? It hasn't changed an awful lot, really, but just worth pointing out that there are a few other things as well which are supporting this. Total US monetary base, it was going down from December 2021 to February 2023. And that to me looks like an uptrend. And that's very supportive, because there's a good strong correlation between the gold price and the total US monetary base. And you would expect that, because what that is really saying is there should be some sort of relationship between the amount of gold that is in Fort Knox and the number of US dollars which are circulating, or the number of US dollars that could be circulating in the global economy. Obviously, mostly the US economy, but actually in the global economy. And you can see that is now on an uptrend. It has been on a downtrend. It has been on a sort of, for most of last year, it was on a fairly flat to downtrend, but it has ticked up fairly decisively. So I would say that is pretty supportive for gold. So I'll tell you what, I'm going to stop sharing my screen there.
Thanks, Charlie. And I guess the summary is that, for 3,200, we're sort of midway through the journey, effectively, that we would expect, or we are anticipating, gold to continue. And there's going to be bumps in the road, as always.
Yeah, it's never up in a straight line, is it?
No, exactly. You mentioned COVID as being one of the differences. The other one of the things that excites people about gold is that actually quite a lot of the demand is strategic demand coming through from central banks. So I mean, I just want to, was that the case firstly in the 70s? Did central banks suddenly, what is that different to the 70s, or is that something similar? And which central banks are now sort of busy accumulating gold?
So I think there are a couple of parts to this. The central banks were actually sellers of gold in the 1970s. They shouldn't have been. They were net sellers. Some, and particularly the creditor nations, were buyers, but there was the Central London Gold Pool, which was basically trying to maintain the Bretton Woods order, and they were basically selling their gold, trying to keep the gold price down to $35 an ounce, in order to keep the system intact. And what happened is that sort of that effectively blew up when Nixon took the dollar off the gold standard in, what was it, August 1971, and then gold was allowed to float free. Had it not been for that, I think the central banks would have been net buyers in the 1970s. They are definitely net buyers now. And there's a very, very, very good reason for that. I'll get onto who they are in a minute, but I got another slide to share, if I can, which just sort of helps to demonstrate the point, I think. And that is that, here it comes. And that is here. Hopefully you can see that.
Yeah.
These are real returns from gold, measured from 1967, when you can say gold began to float. And this is the compound annual average real growth rate and this is for real prices, not nominal prices, that was recorded for the year 1967 to the year shown. Now, depending on where you start these things, I could get you a compound annual average rate of 100%, at the top end, or minus 30%. But obviously, the more years you get, the more sort of blended the number becomes. And the point is, over here now, what we're looking, and we've had it for a while, is with gold, you get a real return of just under about 3.6% at the moment. Now, it might be a little bit higher, it might be a little bit lower, but that's the sort of order of magnitude you're looking at. And so when you're looking at gold and you're thinking, okay, I can get 3.6% with that, what you're really doing is you're comparing that to what can I get with my dollars. And what you can get with your dollars at the moment is, if you stick them with the Fed, you can get 4 and a bit percent, but you're giving 2 and a bit away in inflation. So what you're actually getting real is about 2%. So any central banker who has a pile of dollars as high as the Empire State Building and is thinking, what shall I do with them, is going to say, I can get a better return from gold than I can from my dollars, for which read treasury bonds. And so they're going to naturally go into, and that applies to all creditor nation banks, of which obviously, the most obvious one, and the one that people always talk about, is the People's Bank of China. But there are lots of other creditor central banks. They will all be doing the same thing. If they happen to not be aligned with the US politically as well, like the PBOC, like Russia, like certain sections of the Middle East, you will find that they will also be very quick to convert their dollar surpluses into gold. And that is, you're absolutely right. It's absolutely fundamental. The central banks they used to hold, 30,000 tons of gold out of about 200,000 tons of gold in the world on surface. That will undoubtedly be higher now. But the point is, if all of those central banks that are holding, let's say 40,000 tons, but it's probably high, if they all say, oh, well, I want to increase my holdings by just 10%, that's an extra 4,000 tons of demand, and that dwarfs supply and demand, what we call supply and demand. And that's why people, they look at supply and demand, they say, well, gold doesn't react to supply and demand. Well, it doesn't. And that's the reason why. It's because the above ground stocks are so huge that it dwarfs what's going on in the gold mining industry and in the jewel industry effectively. So don't worry about those two things. It's kind of, this is the dynamic which is moving gold at the moment.
Okay. And look, I mean, so we're going to talk about, how do you take that? So you painted a picture of, a gold price which we expect to continue moving further north. There are different ways of playing that. You can continue investing in gold directly through ETFs and other things. But we're going to talk about gold mining equities because we believe you can get even better returns through gold mining equities. The starting point is, how do they compare as inflation hedges compared to, say, index-linked bonds or real estate, or even, as some people talk about, crypto?
Well, let me take those entirely separately. And bear in mind, I'm a gold analyst. I'm not a fixed income analyst, and I'm certainly not a crypto analyst. However, this is what I'd say about those. Go back to my last chart, and remember that gold gives you 3.6% real. Well, what are all of those other things you mentioned? When you inflation linked bonds, what do they give you? Well, kind of by their nature, they give you inflation. They don't give you inflation plus 3.6%. So that's, I think gold is better than them. My concern with crypto is this. If crypto was not a currency, but it was a company, it would sell a load of its bitcoins, not bitcoins, it's crypto coins, and it would sell them for, let's say, dollars, because that's what you normally sell them. So your liabilities would be your crypto out there, and your assets would be your dollars. Now, these currencies are effectively behaving like central banks. And when one of the things that analysts of central banks they look at is what is the backing of their currency in terms of foreign exchange and gold reserves, and they have some backing. Now, does it necessarily completely cover the value of their liabilities of the currency that's out there? No, probably not. But does it cover very large chunks? Yes, it absolutely does cover very large chunks of that liability. Now, my concern with crypto is that no one that I have seen is asking these questions. And they're not saying, what is the dollar or gold backing of your cryptocurrency? And what I'm worried about is the fact that, there are all these crypto coins out there. What's their backing? And their backing may not be very large because of all of the dollars that might have backed them may not be there anymore. I mean, they may be there, but they may not. But that's my fundamental concern. When I start seeing those figures, I'll become, and if they're sufficiently high, and they should be high, because they're new currencies, they've issued all these coins, they've got the crypto coins, and they should have a high level of reserves. If they do, fine. But if they don't, that would be a worry to me.
Yeah. Okay. Now meetings with investors, you've articulated that there's a cadence effectively in terms of how you invest on the equity side, starting with perhaps the least risky and then moving into riskier assets. Do you want to start explaining that effectively in terms of the sequential progressing of how you see returns evolving and where we should start with, where we are currently in the cycle?
Yeah, okay. Let me get up another slide and hopefully shout when you can see that.
Yeah, we can see it.
Yeah, brilliant. Okay. I never assumed that I'd done those sort of things correctly. And this just shows the relative performance of gold-related equities to the gold price. Now, it's all been rebased so that the gold price is the gold, the gold-colored horizontal line in the middle there at 1. And so what you're looking at is everything relative. In reality, all of those things are sort of all skewed massively up on the right-hand side. But you can see the relative this way much more easily. And I'm going back to May 2019 just to sort of catch what I would call the most recent cycle. That's when we started moving up from about $1,200-1,300 an ounce, and we moved fairly sharply up to $2,000 an ounce. We moved to $1,500 an ounce. I don't know if you remember, in late 2019, the Fed said in response to stress in the repo market, they were going to discontinue their quantitative tightening. As they or they were going to revise it, and they revised it fairly sharply, and that gold bounced on that from sort of 1,200 to above 1,500, and then we got COVID and we went fairly sharply up to 2,000. And what you notice is at that end of the if you can see my cursor at the left hand side of that chart there, what were the things that reacted first? Well, they were the ARCA Gold Bugs Index. Bug standing for big unhedged gold stocks there. The clue is in the name. And to some extent, the UK Gold Mines Index. But they were the ones to react first. So it was the names, if you like, that you would expect. And I think what's going on there is people are thinking, all right, gold is moving. I want to be in a derivative of that, i.e. one of the equities. So I'll get into one of the well-known names. So they get into the Newmonts and the Barracks and the Agnicos. And those are the ones that perform that react first, and I won't say the largest reaction, but they certainly react first, and you get the outperformance, and then slowly you can see that outperformance sort of gives away, and then it starts turning down. And the ones that underperforming at the same time, there are two which are very obviously underperforming there, is the S&P TSX Venture Composite. Now, that is not a pure mining play, but it's what it sounds like, the TSX Venture
Yeah.
Exchange. There's a very high proportion of mining juniors in there. And you can see that that actually underperforms dreadfully for about a year, but for a year after the gold price starts moving, it performs dreadfully. And the other one that performs dreadfully is actually the Australians, the ASX 300 Metals and Mining Index, which performs pretty dreadfully as well. But about a year later, those two start to pick up. And actually, there comes a point where the performance, certainly of the junior, the exploration stocks, is greater than that of the big stocks, which is what you would expect. And then they begin to sort of, the relative performance begins to taper off. And actually, out of all of those, at the end of this period that we're looking at, May 2019 to the present, actually gold has been the best performer. But there are very definite periods where you can get better performance out of selected equities, but you have to sort of know which equities when. And roughly speaking, when gold starts moving, you kind of get the big stocks move first, and then you get the medium, and then you get the small. And to a little bit of an extent, you sort of get North America first, and then you get Australia last. So if you look at right over on the right-hand side here, and you just look at those little ticks up there of the TSX Venture and the Australian market, I think that could be a sort of harbinger of what happened over here when these two started outperforming in sort of May 2020 sort of time. And I think that this might be the moment. I think we already have moved from the big stocks to the medium stocks, and I think this is where the sort of the small medium producers and the juniors that are explorers that haven't yet moved, I think this might be their time in the limelight just now. So that's my sort of thinking. Let me stop sharing that for the moment. There you go.
Okay.
That's my thinking at the moment in terms of how these things. Hasn't always worked like that, I might add. It used to be that they all moved together and the juniors moved most, but I'm going back 30 years.
Yeah. Okay. And within the large stocks, you've got perhaps two varieties of large stocks. You've got the streamers, a Wheaton, which is in there, which is, significant gold exposure. And then you've got the producers, the Agnicos and the Newmonts and people like that. Do the streamers go first, or do they run in parallel? How does it work?
I think for these purposes, for the streamers, and when we're talking streamers, you're kind of talking about the Wheatons, the Agnicos, the Wheatons, not the Agnicos, the Wheatons, the Francos,
Yeah.
and the Royal Golds of the world. They will move with the big unhedged gold stocks. They'll be a first mover, but really, I think I would look at them slightly differently. It's all part of the way you construct a portfolio. But to me, the way you use the streamers is, particularly if you're a retail investor, a private investor, and you think, I want exposure to gold, and the universe out there is huge, and the risks are quite large as well. I'm not sure that I have the time or the energy to look at across the entire spectrum. I just want one stock that will do everything for me.
Yeah.
And that is the streamers. And that's when I'd go for the streamers. So that's if you like, your sort of one-stop shop, where you think, right, I want gold exposure. I want it to be geared. I want upside blue sky potential. I want exposure to the gold price. I want a yield as well. I want all of those things. And I want to get rid of quite a lot of the risk. I want the operational cost risk. I want to go the capex cost risk. I want to go as much as possible. You will pay a little bit more for the streamers. There's no doubt about it, but they have a different business model, and that's the reason you're paying more for them. And they're kind of the one-stop shop, as I say. It's a matter of how you construct your portfolio. So gold over that period of time has outperformed on average most equities. Actually, you'll find that the streamers will have outperformed over a slightly longer horizon. Actually, you'll find that the streamers will have outperformed. And so, in my opinion, they are exceptional investment opportunities. It's not to say you can't find them elsewhere in the miners, but that's your first step. So when you're dipping your toe into the gold market, you probably go into physical first, then you go into the streamers, and then you go further afield.
Okay. And within the report, we touch on, M&A supporting effectively this. So Goldfields bid for gold resources, Alkane, I guess, merging. So we're starting to see a little bit of on the sort of corporate activity as well. Do you normally anticipate sort of M&A accompanying the cycle?
Yeah, absolutely. And it's much easier, I think, when you've got a supported gold price as well,
Yeah,
behind you. It's it's always a tricky one because there are a huge number of companies out there. Really, a lot of them are up for sale at any one time. And to pick the right one is a difficult thing to do. However, it does happen. It can give you very decent returns. What I would say is beware of this one. There's always the hope that the majors are going to buy the juniors.
yeah,
That almost never happens.
yeah,
The majors require the juniors basically to get themselves into production, and then when they're of a particular size, and I think that size is about 200, 250,000
yeah,
ounces, less than that, the majors aren't interested. But once they're in production with at least a pathway to 200, 250,000, that's when they get gobbled up very, very quickly. And actually, if you look at a sort of a frequency distribution or a histogram of the mining market, and you do it by size or revenue along one axis and frequency up the other axis, it's hugely right skewed, which means there are massive, massive amount of companies that have no revenue at all, and
yeah,
almost no companies which have a huge revenue, and the ones in the middle are very underrepresented. And that's because either the juniors haven't got there, or because as soon as they've got there, then the majors take them out. It's a bit like, you see it in the oil sector as well. The likes of Lasmo suddenly getting bought. I can't remember who bought Lasmo, but it's the same sort of thing. You get to a certain size, and the major, I think it was BP, said, "Yep, we'll have that. Thanks very much." And then I won't say they'll pay any money, but they'll be prepared to pay a generous price in order to get what they want.
yeah. And how does and as we're talking about M&A and the assessment of valuation, I've worked with you a long time, Charlie. I know your summer project of updating the spreadsheets to get to a sort of a new sort of long-term gold price to stick into your valuations. Um, when gold is sort of, pushing up past 3,200, what is how are you factoring that in? And perhaps an easy way of thinking about that is, what was your long-term forecast last year, or what kind of number were you thinking about last year, and what are you thinking about this year?
I mean, my well, my long-term forecast probably hasn't changed that
Yeah,
much.
yeah, okay.
What we're looking at is we're looking at a cycle. There's a sort of fundamental price, and then there's a long-term
Mm-hmm.
price. But what I would say is I am expecting, that assumes, because I've only really got one cycle in history to look at, and that was
Mm-hmm.
71 to 81, where there's a big run up. And then Paul Volcker came in and said, we must defend the dollar, put real interest rates up. That killed the gold market for 20 years. But it took gold, the real interest rates being at 4% or more, to kill that gold market. And 4%, the reason it's 4%, in my opinion, is because if you can get 3.6% real return with the gold market, you have to offer more in the fixed income market for that to become
Yeah,
relatively
yeah,
attractive. The point is that there's the fundamental and the sort of long-term price, but in the environment we're in at the moment, it's still very positive for gold because real interest rates are just not at that level. So my current year gold price is much higher than my last year gold price. Fundamental gold price was sort of is further out is probably lower than that, but that is absolutely contingent upon real interest rates going to 4%. Now,
yeah,
might they? They might, but they're showing absolutely no signs of it at the moment. So, you'd have to have interest rates about 2% higher than they are at the moment. So instead of 4 and a bit% in the US, it had to be 6 and a bit%. And you can imagine you would have a miserable, miserable recession a la 1981 if you were to do that again. And all the political forces are against that. And to some extent, some of the economic forces are, because in 1981, the US was a huge creditor nation, and now it's a huge debtor nation. So it doesn't, there isn't the same onus upon it to defend the value of the dollar, it can actually allow the dollar to move in such a way as to become competitive on world markets. And I think but all the time that's happening, and real interest rates are less than that 3.6%, 4%, that's very good for gold.
Okay. And just a quick reminder that if you do want to pose any questions, please do through the Q&A facility. Charlie, let's talk about, okay, you want to put money to work. How do you think about sort of constructing a portfolio? What is the sort of optimal allocation effectively? Of course, you've got to be, aware of people's risk tolerances in this, but if you're thinking about sort of allocating to, large, mid, and explorers, how do you go about doing that? And to physical gold as well.
So first of all, I guess you've got to say, what's the size of your portfolio?
Yeah.
How much can you allocate? How many units of that can you allocate into gold? And if the answer is one, then I would say you're looking at gold physical and all the streamers.
Yeah.
Now, if you're looking at two, you're probably looking at gold physical and a streamer, or maybe a major, or maybe two, maybe a streamer and a major, something like that. So you have to be looking at, I would have said, at least three stocks, and assuming, you want to get a 20% weighting, that's quite a large portfolio you're looking at. You're sort of, that's a 15 stock portfolio. All right, you've got three geared towards gold. Well, then you're looking at physical, you're looking at a streamer, you're looking at a major, but maybe that's the point where you're thinking, well, maybe I could go into the mid tiers, maybe I can go into the juniors, but that's the sort of, you need to be at that order of magnitude, I think, before you're playing in that sort of market.
And I mean, within the report, we talk about 1 to 3 sort of positions and sort of junior explorers optimizing returns. So I mean, why that number and not 20 or 40? And what criteria, if you were guiding someone through in terms of picking a junior, what criteria would you use?
Okay, so first I'm going to do some shameless publicity there. This is the report to read, and this is what I'm about to sort of talk to now. And this is something I wrote in October 2016 called The Long and the Short of It, and it's how to construct a portfolio of, this is specifically juniors, because this is where I get the 1 to 3 number from. And what it dates from is, it dates from my predecessor, Mike Wood, who you'll remember at Edison. And he wrote a report called Pay Dirt, and it featured 10 stocks which were going from explorer to producer. And he said, and this is where you make your money. And he's absolutely right with that. Or this is where you make outsized returns. And he's absolutely right. But you don't make them on all of them. So 5 years later, I came back and I said, all right, let's have a look and see how these stocks have done. And, you will remember this, but 7 stocks, you lost almost all your money.
Yeah.
1 stayed where it was, 1 was up 3 times, and 1 was up 5 times. And if you put that all together, you've got a kind of all right portfolio return. And this, but it was because you had a lot of stocks going down a long way and a few going up a very long way, nothing actually, only 1 stock out of 10 performed close to the average.
Yeah.
And that has some quite fundamental consequences for portfolio allocation. I've got another slide, if I may, which I'll show you here, which demonstrates where that 1 to 3 comes from. So remember, this is out of 10. So, you might say this is a teeny bit esoteric, because you've got to have room in your portfolio for 10 juniors here. So, you might, if you've got more than 50 stocks, you might have room for probably more than 55, 60 stocks. So you might be Evie Hambro at this point. But if that's the water that you're fishing in, and you can have a portfolio of juniors that large, then this slide here shows you what's called the efficient frontier. And so that's showing you everything sort of within that gray line is an achievable portfolio return for you. I also did this for the short portfolio, but I've cut it out. You can read it in the report, but for the purposes of this webinar, I just looked at the long portfolio. And then it says, okay, if you got a risk-free asset, now I've defined a risk-free asset as being gold here. So over the period of time I was looking at, risk-free, there you are, zero risk. What did you get from return from gold? Well, you got that return, it's 20% or something. It's a very high for a risk-free asset. And then you draw this tangent here and you say, all right, well, where is that line tangential to, in order to get the most efficient portfolio? So this is including a risk-free asset. And the answer is it's at 3 stocks. So that would be 1 stock, that would be 2 stock, that would be 3 stocks. So if you've got a risk-free asset, which is gold, then that's where your 3 stocks. And remember, it's 3 out of 10. It's not 3 absolutely. It's if your junior portfolio is 10, then you want to look for 3. Now, if you take that out, then this is the other way of looking at it. If you take it out, here's your out. This point here is at the average, because that's, you've got 10 equal weightings of those 10 stocks, and that's your average return just there on the sort of point of the nose on the left-hand side. Now, what's different about this, and I talked about, I sort of alluded to this before, is that if you were looking at industrial companies, you would find that most of the performance would be close to the average, and there would be a few outliers. And that would make this shape much more symmetrical.
Yeah.
But this is very asymmetrical. So if you imagine you're here at the average point where you've got 10 equally weighted stocks, and then you say, well, what happens if I go to 9? Well, the best you can hope for, that's the uplift. It's very, very small. What's the worst you can hope for? That's the downshift there. If if you don't get a winner, you get a loser. You're losing a lot more than you win. So probably you want to stay with 10 stocks, not 9 or 8 or 7 or 6 or 5 or 4 or 3 or 2 or 1. You want a fully diversified portfolio. So, when you're thinking about all these things, do you have physical gold is an important consideration, because if you do, and it generally outperforms, you probably want fewer equities on the long side. If you don't, and you're just looking for your equities to get performance out of your equities, for the best risk return, you're probably looking at a fully diversified portfolio. So quite a lot of things to consider. It's not the easiest sector in the world, but there are fantastic returns to be gleaned from it.
Yeah.
And in fact, that report, features one of them, which is, Sirius Minerals, which is long gone now, Australian nickel in Australia, not to be confused with Sirius Resources, which was halites up in Yorkshire. But if you held that at the right time, 70 times your money.
Yeah, I understood. And boil it down to, lots and lots of factors to look at when you're looking at Explorer. But if you're going to weigh them up in terms of criteria, what 3 things would really matter to you?
I think probably a good jurisdiction. It doesn't have to be perfect.
Yeah.
Driven management who understand financial markets, because those are the markets that they're operating in. That's very, very important. And then I think, everyone always says it comes down to management. Actually, it kind of does come down to management.
Yeah.
You need a management who understands what they got, how to market it, and where they want to get to as well. And therefore, they've already done the work of deciding, right, which jurisdiction do I want to be in, and why do I want to be there? And then they can move their stock, their story, their dream, if you like, through the process of getting from exploration to production. You don't want a stock which is, you probably don't want one which is eternally exploring, and those do exist. You need for them to have some idea of how they're going to get out of that position. Okay.
Let's move into talking about some stocks, and these are things that you cover or well. Agnico Eagle Mines trading at potentially one of the largest discounts to theoretical P against the large producers. What is driving that, and what's its sort of performance against its peers like?
So hopefully you can see that
Yeah,
screen that I brought up. So this is so Agnico. It's very easy to look at Agnico and think that's expensive relative to your Barracks and your Newmonts and your Kinrosses. But if you look at Agnico, its performance, its earnings performance over, and I've taken this period 2010 to 2024, is noticeably superior. So the Agnico point is this one over here. So higher earnings performance than the others. And then if you say, all right, given that earnings performance, what you say, what should the stock be worth? And if you say it should be worth the sum of all future earnings, what is that? And then you say, well, divide one by the other. What PE should it be on? That's this line here.
yeah, okay,
And so if you look at Agnico, although it is more expensive than Kinross, Newmont, Barrick on that current year PE ratio, it is way below where it actually should be, given the earnings performance that it has given over that 14-year, that 15-year period, actually. And that's why when I say that, I think it's the most underrated, the difference between the pink point and the blue line is greater there than for any other stock. And Wheaton, Wheaton looks overvalued, but I would say, look, it's a different business model, so I wouldn't look at it in the same way on this chart. If it were a gold miner, it would be overvalued there. As a streamer, I don't think it is, because you've got the lower risk as well, which is what's helping it out there. But that's why, one of my favorite majors at the moment is Agnico,
okay,
despite the fact it appears at first glance more expensive than the others.
yeah. Let's talk about a kind of mid-tier producer, something that's done really well over the last few years, Pan-African. Good run over the last 4 to 5 years. I think I was talking to a fund manager who felt like he'd missed the boat with it, but is this something which is still worth taking a look at, and is there sort of further upside potential for it?
If you look at, simple ratings, definitely cheap compared to its peers still. I mean, you have to remember that when it started its run, so, and you got all this fantastic, it's gone from 10p to 44p, so it's done very well. It is still cheaper than its peers. It is still cheaper than it has been historically. So
Yeah,
yes, you haven't, you missed some of the boat, but you haven't completely missed the boat. It's still one you can get on board with. They've got this very exciting acquisition they've made in Australia, and I think that's a new horizon for them, and I think that could be very, very important for them. At the moment, the Australian project doesn't have a very long life, but I think there's lots of blue sky upside potential there. And they bought it for that as much as anything else. And, if you try and value that and you say, and you put it on a terminal multiple rather than just looking at the assets as they stand, again, there's more upside again on top of that. So no, I mean, there's definitely left to play for in Pan-African. Tracks a bit of a discount because of South Africa, but actually, compared to its South African peers, it is way below the radar in terms of the publicity it attracts in the mining industry. Anglo-American Sibanye, they get all of that.
yeah,
Pan-African doesn't. It can just quietly,
yeah,
move through the process of producing gold very, very efficiently, I might add. They've also just opened another project, the MTR project, out on the West Rands, which they've ramped up. And this half year from December to now should be sort of the first proper half year of production. So that is going to contribute. So, they got two significant projects coming on stream. So no, there's a lot to play for there as well. Something that's been depressing their earnings recently is they went for a funding facility to build the MTR, the Mintails project,
yeah,
which meant that they had to do a sort of synthetic forward sale. They haven't been getting the full benefits therefore, of the gold price
yeah.
um,
Okay,
in the last 6 to 12 months. However, that ran out in February. So I
okay,
expect the half year from December to June to look significantly better than the half year from June to December last year. and then going forward as well. So I think you can still see the potential for earnings to go up several times for Pan African.
Okay. And then we can talk about a junior. Then I'm going to throw you some wild cards and see how you fare. Okay. The a junior Kefi Gold and Copper, again, which we've been covering for a while. What's the assessment of the geopolitical risk in Ethiopia, and how do you factor these into your valuation? Where do you see that story developing?
Good question, and I don't for a very good reason, and that is because I don't want to set myself up as an expert on
Mm.
Ethiopia. So
Yeah.
what I want to show is I want to show what is the upside on this stock,
Yeah.
because the downside is easy to do. So what is the upside? And it's trading at a halfpenny, roughly, a bit more than. Even on my long-term gold price projections, which are more like 2,000, which are give or take 2,000, not 3,000, and certainly not 4,500. But if you get 2,000 and they get into production and they execute the plan, the mine roughly according to plan, should be worth at some point in the future tuppence halfpenny, something like that. Tuppence halfpenny, threepence. You're in that order of magnitude. Now at 3 and a bit thousand, you're probably looking at sevenpence halfpenny, something like that. So you're looking at 15 times upside.
Yeah.
Now, the reason why I don't want to set myself up as an expert in Ethiopia, have I been there? Yes. Did I have a perfectly nice time? Yes. Did I look at the mine? Yes. Could I see any problems? No. And that was, we've all read what has happened in Ethiopia. That seems to have calmed down almost completely now to a very large extent. But I know from experience there is a very, very, very long history of analysts sitting in London looking at a situation from 10,000 miles away saying, I can't see any problem. Probably the most famous one was the East India Company.
Yeah.
And they sent back a morning meeting note to London every day. And one morning the clerk wrote, and I'm paraphrasing a bit here, pretty quiet, not much going on. That was the day the Indian Mutiny started. So, you have to have a bit of, I think you have to have a bit of, I would say, humility here, to
Yeah.
understand that your ability to understand what's going on the ground in Meerut or in Addis Ababa is limited from where I am. So what I'll do is I'll tell you the upside. My experiences in Ethiopia have been good. I was there last October, not for a very extended trip, but I was there. Seemed like, I won't say any other African. It was a very good experience compared to a lot of the African countries that I've been to. Airport completely new,
Yeah.
like Gatwick. Now, last time I went there, which was a few years ago, it looked like an African airport that had been thrown up in the 1970s with cheap wood paneling and people smoking everywhere and suitcases, lying in puddles, sort of thing. It now looks like a modern airport. So a huge amount has obviously happened there. My experience was great. Can I absolutely guarantee that I saw all aspects of the country? I know what's going on. No, so there is risk there, but you, the investor, you'll be able to look at Ethiopia and come to as good a decision as I could, in my opinion, about what the political risk is. My feeling, as I say, from being there, is that the political risk is muted.
Okay. And look, there are a couple of questions have come in, and people wanted your views. Now, given the number of stocks out there, we may not have them, but I guess I'll ask Pavlina and Mark to just make a note, and we can always come back to people after taking a look after that. But do you know MSL, Metals Exploration?
Metals exploration, by which I assume you mean a gold producer in the Philippines.
Possibly.
Yeah, if it is, as long as it is a gold producer in the Philippines, I know management. I've never been there. I like management. They had some trouble in the Philippines a few years ago where they became wastebound. They seem to be out of that. They seem to have been refinanced. I think they're one of the stocks that has done pretty well. Used to have a model on them, but it's too long in the tooth to revisit it now. But yeah, I'd say I rate management. I think they know
Okay.
what they're doing.
Okay. And one which was Westlake Gold Mines.
Don't know them, I'll be honest.
Okay,
Probably
that's fine. That's
shouldn't
fine.
shouldn't comment.
I'd be impressed if you did, Charlie. There's a lot of stocks out there. So, but what we will do, Greatland Gold.
Greatland Gold. So what I know of them, they've been through a few iterations. There was a time when they looked like one of those eternal explorers, but they bought Telfer from Newmont. I'm going to say last year. I think it must have been last year because Newmont, were selling various of their assets, and that will have absolutely transformed the company from explorer to producer with a big asset in Australia. A good part of the world don't have a model on it. Have a model. Never have had a model on it. Have been aware of it, but I can see that it's been transformative.
Okay. And final one, or we'll keep an eye on time, Sarabi Gold, which we have looked at in the past. I remember.
Yeah, in Brazil, again, I knew management. They understood what they were doing. The thing that makes it difficult to analyze, I remember, is they're looking at wiggly, anatomizing, a geologist would say, veins in Brazil. And the particular danger of that, the difficulty of that, is it's difficult to intersect those veins from surface. So it's difficult to come up with a reserve and resource that makes it look like the life is very long.
Yeah.
However, most of those mines, if you've got a wiggly vein, you can follow them. I won't quite say ad infinitum, but you can follow them for a very, very, very long time. So whatever it looks like the life is probably, I would have said, at least 10 years. And then, as I say, last time I looked at it, long time ago, so I'll be out of date. I remember that was the difficulty, but management understood that, and they understood completely what they were doing. So it would get a kind of a fundamental thumbs up from me, and then you have to argue about what you think the right price is.
Okay. All right. Thank you, Charlie. I'm just keeping an eye on time. Oh, there's one more that's sort of come in. Let's see if we can talk about it, and then we'll try and wrap up. Anglo Gold Ashanti, which bought Centamin, and talk about the fact, the benefits of consolidating in a rising sort of pricing environment. That seems to have done well. Is that just the benefits of becoming bigger, or is that something else that's also driving that?
Yeah, I mean, Anglo Gold Ashanti, or Anglo Gold, Anglo American Gold and Uranium Division, as I remember them a long time ago.
Yeah.
I'll throw a few names: Clem Sunter, Bobby Godsall, Kelvin Williams. That was the sort of team that I knew there. Of course, Anglo Gold Ashanti, to be honest, it's a different beast from the one that I remember. It's a major now, and it has to be looked at as one of your majors. So it can be one of your sort of fundamental anchor stocks, if you like. It's not like any of the ones we've talked about so far. Like those big gold stocks, it has some good assets, and it has some less good assets. You can take Anglo Gold Ashanti and you can look at it next to your Kinross, your Newmont, your Barrick, and your Agnico Eagle, and you can come to a view of how cheap does it need to be, kind of thing, relative to the other ones before I buy it. But almost certainly has good gearing to the gold price, I would have thought. But that's one of your anchor stocks.
Okay. So
Can I throw you one?
yeah, go on.
Barton Gold, you should have a look at.
Yeah, absolutely. It's done really well.
Yeah.
I only saw the announcements over the last couple of days, but it looks like it's a transformative story there.
Yeah, I think it is. So you remember when I said, you want juniors who have management, who absolutely have a plan in mind for getting a company into production, in this case, quickly. It's being driven by Alex Scanlon, who's can't remember if he's MD or CEO, but he runs it. He's got a very, very clear vision, and he's very, very driven to get into production next year. He's got several assets in South Australia. He's in South Australia for very, very deliberate reasons. He's trying to get all the synergies out of it that he can, and he will find a lot. He absolutely understands how damaging equity dilution is to shareholders. That's something that he's working very, very hard to avoid by monetizing other assets. He's sold several $1 million worth of assets like gold concentrates, things like that. That's well worth a look at. And the other one, I would say probably that you touched on is Alkane, and they were the one who merged with Mandalay.
Yeah.
And that's because again, they had about 100,000, a little bit less, 100,000 of production put together with a similar sort of company, and a merger of equals. You're suddenly 200 odd thousand of production. You're into that range now. most of it in Australia, a little bit in Sweden, but you're now into that range now where they will attract attention. They will attract a re-rating from index following index tracking funds, as you know, as they go through sort of various milestones. And also they will attract interest, I think, from the majors as well. So that'll be one to look at too.
Yeah. Okay. And the final one we've talked about a lot. And I was put it's like I was put on the spot when we were going through best ideas, and so, well, if you had to pick one, which one would it be, right? And it's like picking your favorite child.
That's easy.
So if you had to focus people on one name today, that you thought, look, if you're interested in getting exposure to gold in a sort of sensible way, what would it be?
Okay, I'm going to rule out physical. And because it's one, because you said it's one, I'm going to rule out the juniors. And that really leaves you with just the majors and the streamers. And I think I said this, and this was my whole thesis. If you want a one-stop shop and you want as much of the benefits of exposure to the gold price as you can possibly get, and you want to defray as many costs as you can, and you know you don't want to do a lifetime's worth of research or an analyst's worth of research, then it's a streamer. And so I would say your one-stop shop, it's got to be Wheaton.
Okay, perfect. Thank you, Charlie. It's been great, a great canter through gold equities. We love doing this. And let me welcome back Mark when he's ready. If there's any other topics that you would love us to bring, we have a 30 strong analyst team. I know we've got something coming up in July, but happy to you know, bring other sessions like this to you. Charlie, thank you very much for the run through.